So in chapter 23, we're looking into the income distribution and all the other ramifications, including, again, the income inequality, poverty, discrimination. All this boils down to that income distribution. Okay. So first, when we talk about, probably should start with financial capital. We'll start with physical capital. Physical capital. If you drill down on it, it consists of both human capital and financial capital. Human capital, of course, is what we do to develop ourselves. The experience that we gain, the on-the-job training, the actual schooling, formal, informal, etc. And the financial capital is the underlying part of the physical capital also that you find at a firm. So if you think about it, the machinery and equipment that's at a firm, for example, it's owned by the company, right? So that $1 billion piece of equipment is owned by the company. But if you think about it, who actually owns the company? The owners of the company are the shareholders and also the bondholders, right? So it's that financial capital that we're talking about that is subsumed into that physical capital, or it's part of that. It's the underlying part of that physical capital is the financial capital, and it comes in two different categories: debt, and how debt is compensated is through interest, and equity, and equity is compensated again to some degree with interest at some point, but also through dividends and also through capital gains. I should add that as well. But that's only in the event that if it's realized, it's when you sell your share of stock, and assuming you have some capital gain, some gain on difference in the price that you paid and the price that you sold. So the three that are discussed here again are financial capital and physical capital and human capital. So kind of the question is, what makes that human capital unique? What is the link between education and income? In general, we're saying the more human capital you embody, you possess, the more that you've inserted into yourself, if you will, the more likely your compensation will be higher. Again, it depends upon so long as that education is something that is pertinent or is desired, if you will, by your potential employer. So, but again, in general, the higher the opportunity cost associated with your human capital, the more human capital that you have, the greater is the reward. That's the relationship, the general relationship, right? Again, now when we start looking at the educational attainment, and granted this is rather dated, I should have newer information here, but frankly, when we start drilling down on a lot of this information coming from the Census Bureau, it's usually at least a year or two after, it seems. So it's not typically the next year, for example. So at any rate, so if we're looking at that resource labor, when you're being paid more than a mediocre wage, including benefits, an average wage, it's because you've embodied in yourself that human capital that we described, the additional training and so on and so forth, right? And this is again indicative of the more education, the educational attainment, the more education that you have, the higher are your earnings. Higher is your earnings, rather. And on the left, we've got the weekly earnings, and just remember weekly, just multiplied by 50, and that gets us where we're at so far as the 52 weeks, I guess. But anyways, 50 is enough. So if we're looking at doctoral degrees, professional degrees, we're approaching the $100,000 mark. And that's probably on the low side now, of course, but anyways, you get the idea. So using that kind of as a rule of thumb, less than high school diploma, we're probably talking on the order of under $30,000 a year. Not that there's anything wrong with that, it's just that if you add some education to that, in general, we're saying, not in all cases, adding some opportunity cost, something that makes you worthwhile to your employer is going to benefit you so far as your compensation is concerned, your income. So on the right, we've got the same type of a setup where we're looking at, it looks like it's a bit newer information as in 2019. And the more education that you have, the higher the educational attainment that you reach, the more you're going to be compensated in general. So again, with this, the U.S. Census Bureau clearly shows us, for example, the population group between 35 and 54 years of age, the tenured workers, so-called. So you're in the workforce, you've been in there for a while. If they haven't made it yet in an economic sense, it's likely that they won't. What that means is that unless you're, it shouldn't even say that unless you've made it by then, you won't make it going forward. The idea is that you'll just have to work longer, harder, whatnot, in order to achieve the your aim so far as like a comfortable retirement, right? So again, educational attainment. If you look further at their educational attainment, you'll find that more education received, again, the greater likelihood that the person will have a higher income. There are always exceptions to the rule, of course. When you start looking at a lot of entrepreneurs that are out there that they received some education for the most part, and then they stopped along the way. Classic examples again: Bill Gates, variety of others. The names just don't come flooding to the surface. But there are many people that have gone out there and not gotten a college degree and are doing very, very well, right? They reached that point where they said, "Nope, it's not worth it to me. I'm just going to go out there and find some other way to make this happen." So further, when we're looking at the correlation, if you will, the direct relationship between educational attainment, and overall economic well-being, better overall economic well-being, higher wages, of course, the median usual weekly earnings, doctoral degree, of course, you're getting much more than you're getting at as a high school, receiving a high school diploma. So this is where we start, and on the right-hand side, we show the unemployment rates, of course, being very low for folks that are higher degreed. This is where we start getting into the conversation about what does all this mean? And what I'm saying, or what I mean, I should say, when I say that, is that embedded in all of these degrees, if you will, whether we're talking about high school diploma all the way up through that professional doctoral degree, all of those degrees require a lot of work, a lot of opportunity costs are expended, correct? So this is, again, just another way of looking at this. So you're investing in yourself now, and the payback will come down the road. Hopefully not too far. On the right-hand side, it's interesting. This is, there's all of these, remember, statistics, you have to really be careful about how you look at them. But in this instance, we're looking at 1940, 76% of the population over 25 years of age had less than a high school completion. 20% had high school or some college, and only 5% had a bachelor's degree or more. That was 1940, as opposed to, fast forward to 2017. A bit over 10 had less than a high school diploma and or some college, close to 55%, and then well over 30%, 34% have a bachelor's degree or higher. So there's been much, much more education. So the quantity of education has increased. The questionable part, or the part that sometimes causes some heartburn with people, is the quality of the education. Has the quality of education, has that increased? And this is kind of open for discussion, debate, and I'll probably be talking more about this as we go forward. So here are some basic statistics, if you will, about the U.S. as it stands right now. Of course, the overall population, whether you realize it or not, we're well over 330 million in the U.S. So we are the third largest country population-wise in the world, behind China, India, and then it's the U.S. So we are right up there, and that's going to be changing in the years to come. But nonetheless, we are a force to be reckoned with so far as population is concerned, and also geographically, we're quite large as well, of course. Behind Russia, Canada, China, and I believe we are fourth in that category too. So we're large and large. How about that? So in 2020, the median income was family income, right? So this is the household income. So this is everybody in the household. So if there are two parties working, this would be 2 people earning about $34,000 a year. And you divide that by 2,000 hours, 2,000 hours in a year, it gets us to about $17 an hour. So 2 people earning $17 an hour, maybe $17 to $18 an hour. So, again, this income, some people it sounds like a lot, others they say, well, it's not as much as I thought it might be. And this is where we start getting into some discussions about what we mean by such things as poverty. So I'll just introduce it right now, and that is that in the U.S., yes, we do have poor. We have what are called poverty, and the individuals below the poverty line in the U.S. Again in 2020 was a shade over about 11.4%. So the thing I want to bring up here, 2 things. One, we'll talk about the chart, but when we talk about absolute poverty versus relative poverty, in the U.S., do we really have absolute poverty? Do we have sub-Saharan Africa poverty? And the answer to that is no. We do have poverty. We do have real poverty, but we don't have poverty to the extent that we have people starving to death, for example, as is the case in some parts of the rest of the world. The good news is that that's actually diminishing. There are fewer people that are starving to death. It's just sad to even think about, honestly. At any rate, so for all intents and purposes, a poor person, a person under the poverty line in the U.S. is much better than a person under the poverty line in some other country, right? But nonetheless, no one likes to even think about these things. But the reality is that we do have a significant amount at 11%. So 1 out of every 10 people, if you will, or a bit more. So on the right, we're looking at the household incomes in the U.S. and how it's changed over the years. And what you'll notice is you look to the far right, most recently, the real median household income has actually fallen. A lot of that has to do with what? It has to do with what occurred during COVID. And just nonetheless, even when we track back, a few years, it's just amazing how high this or how rapidly our real median household income has increased in recent years. It's really quite remarkable. It's gone down a bit, and hopefully we'll get that back up again, but more to talk about as we go forward. So when we talk about poverty, and I said I already talked about absolute poverty versus relative poverty. Even in the U.S., when we measure poverty, there are a bunch of different ways of different methods, depending upon the government agency, and also within government agencies, different measures or metrics, how they measure poverty. It's actually just mind-numbing to be totally honest with you. But anyways, let's just go through an example. So we have family A has 5 members, 2 children, 1 mother, 1 father, and 1 great aunt living again in this one household. So the first step, determine the family's poverty threshold for the year. The family's 2020 poverty threshold is $31,661. Secondly, now we calculate the total family household income for the same year. Suppose the members in the income in 2020 were 0, 0 for the children, mother 11, 11, and the great aunt 10,000. So thus, the family's total income for 2020 was where? Just a shade over the poverty line at 32,000. Step 3, compare the family's total income with the poverty threshold. Again, the total income divided by the poverty threshold is called the ratio of income to poverty. And again, in this case, their income was 32,000 and divided by that threshold of 31,661 brings us to 1.01. So just a shade above that poverty line. The difference in dollars between family income and families' poverty threshold is called the income deficit for families in poverty, or the income surplus for the families above poverty. And again, in this case, the income minus threshold, the 32,000 minus 31,661, the poverty threshold, equates with a $339,000 surplus. Okay, so the conclusion, since family A's total income is greater than the poverty threshold, they were considered not in poverty according to this official definition. Of course, there are always some oddities. Nothing is ever as straightforward as it might appear or would like people to like it to be. There's always some twist. So again, moving from 2019 through 2020, this is COVID, right? Median household income dropped from 600, approaching 70,000 down to 67.5. Poverty, number of people, percentage of people in poverty went up. The supplemental poverty measure actually dropped. It went down from 11.8 down to 9.1. Educational attainment, high school grads are higher, close to 90%. The health insurance coverage, the percent uninsured from 2016 to 2019, the rate of uninsured persons increased by a total of 1.7%. From the 10.4% in 2016 to 12.1% in 2019. Over the period, the uninsured rate decreased by 6.8% from 18% down to 10.8%, 18.2% down to 10.8%. So the total number of households, remember we have 330 million people living in the country, the number of households that those people are crammed into or put into are 129.9, so nearly 130 million. So we're looking at less than 3 persons per household, right? Number of companies, this is just as an aside, I wanted to throw this in here. The number of identified companies in the country amounted to 32.5 million. So this would also include probably primarily small businesses, but nonetheless, they are counted, and it's just interesting that number is actually quite high, isn't it? So as we continue with this household income and the income distribution thereof, it's interesting as we think about it this way. Usually when we talk about income distribution, people think of the middle class and the disappearance of the middle class. The reality is that while it might be moving around a bit, there's always a middle class, because what we're talking about are quintiles, income quintiles. It's divided up into 5. And so in essence, what happens is that the middle fifth, if you will, is that middle class. It's that where the median would be found, and so on and so forth. At any rate, this is the way that it's broken down. So we're looking at roughly 130 million households, based on census data. So the lowest fifth would be the 26,000 and so on and so forth. The second fifth, 26,000, and all the way up to the fifth quintile, divided up into 5 categories, and the income that's associated with that. So the lowest fifth is the lower limit, starting with the lower limit, is at $0, obviously, and it goes up to about $27,000, and then the second fifth The lower limit starts at 27,000 and it goes up to about 52,000. The middle fifth, the middle income, goes from about 52,000 up to about 85,000. The fourth quintile starts at about 85,000 and it goes up to about 140,000. And the highest quintile, the highest fifth, starts at 141,000 and goes up to Jeff Bezos territory probably. Anyway, you get the idea. This is how it's divvied up. And it also has, so you have the highest fifth, and then taking it a step further, the highest, the top 5% broken out of that highest fifth, it starts at $274,000 roughly. Again, this is household income. So these are huge numbers, obviously, but the reality is like in the middle fifth, the third quintile, if you will, goes from about 52,000 up to 85,000. It's not that much. And yes, if you're sitting in a classroom, you're probably not earning that kind of money, but the reality is if you break it down, just divide by 2,000, you'll get hourly wages of, we'll just say, even at the 85,000, we're talking about 42.50 per hour, which is, that's the combined. So you have two people earning what? $21 an hour, $22 an hour. It's a lot of money, but at the same time, when you think about it, it's not as much as you might think. So these are all relative and so on and so forth, but these are numbers. These are good numbers. They're arrived at again through the Census Bureau, and it's from the Annual Social and Economic Supplement, the CPS. This is the same folks that do the surveys for the current population survey, that they do this for determining unemployment and so on and so forth. So these are good numbers, and meaning what I'm trying to say is that these are good numbers for you to kind of get your head wrapped around, so that you have some notion, some idea of what that income distribution, what that really means when it comes right down to it. So this next section, what we're looking at is just read the label: average income, means tested transfers, and federal taxes. So part of the rationale behind taxes, federal taxes in particular, it was based on trying to make the income distribution more equal. So if you're earning more money, if you're earning higher salary, higher income, there's kind of that leveling process in that you're paying a higher rate of taxes based upon how much income that you're earning. But anyway, let's walk through this. So the income before taxes and transfers is pretty straightforward. And that continues moving to the right, moving rightward, meaning that you'll see where it was at, where it started. And so the means tested transfers, most of that is going to low income people, obviously. Again, means tested transfers, that would be basically on the order of like welfare payments and various subsidies that would be going to out to individuals and households, etc. So less taxes would be taken out, the federal taxes, and so those are again the transfer payments, the means tested transfers. We're talking about transfer payments, federal taxes, and of course they're the richer people, the ones with higher income, the higher income earners are taxed at a much higher rate, or a significantly higher rate, we'll say that. And in fact, what you'll notice is that the majority, the vast majority of all taxes are paid by the higher income people overall, like in toto. And when you start getting down to the very low income, they're not paying much, if anything, in the form of taxes. So the last is the income after taxes and transfers, and of course the lower income people have higher income, if you will, after the transfers and the taxes are added to and taken out. And it also reduces, of course, the after-tax income for the higher earners, right? That's the objective, and that's what happens. When we're talking about average federal taxes, that means the overall. You may be taxed at the way the tax system is set up, you're taxed at marginal rates, lower lower income. So if you're earning $50,000, say the first 25,000, and I'll have this information as we go along, the first 25,000 might be at 10%, and the next 25,000 might be at 15%. So when we talk about the average, this is the total. When we look at the total taxes that are taken out, and so what we're saying then is that the highest quintile, for example, they're paying an average tax, an effective average tax of around 27%, whereas the lowest quintile are paying 1.5%. Again, this is the federal. This is at the federal level. The top 1% are paying a third. They're paying quite a bit more, right? So again, focusing on the federal level, looking at the various taxes, it's not just, of course, it's not just income taxes, but what's interesting is that on the income tax part, the individual income tax, the lowest quintile pays a negative 12%. What that means is that they get earned income credit. The second quintile, again, this is on a net basis, minus 1.3%. Again, they're receiving, they're getting money back. This is that earned income credit, EIC. So the top 50% pay again 90% of all taxes. So the fourth and fifth quintile, in essence, pay 90+% of the taxes. Okay. Actually, part of the middle quintile too. So half of that would be tacked on for taxes. It's this is it makes sense in a way. Think about it. That the higher income earners would be paying at a significantly higher tax rate, so the taxes collected would be much higher coming from them. But one of the arguments is that you have to have some skin in the game, meaning that everybody should be paying some taxes, some income tax. It's one of the arguments. Nonetheless, this is the breakout as it is. The next one we're looking at is the corporate income tax. And it would make sense that the corporate income tax would affect the higher income earners more so, because the corporate income tax they're the ones that have ownership of more equities, more stocks, for example, and bonds. Payroll taxes are higher at the lower levels because of such things. What's included in payroll taxes? Withholding taxes, the federal income tax, withholding, also Social Security, Medicare. That's the biggest portion. So the lower income earners would be paying more because, again, the higher income earners, there's a cap on Social Security, being collected. So that's the rationale. That's why as we move across 9.8, 8.5, 8.9, 9.3. At that point, after that point, it goes down because you're earning beyond the cap, beyond the level of where you're actually contributing to Social Security and Medicare. Social Security, not Medicare. Medicare is always contributed. Again, those are payroll taxes, and last are excise taxes. And they would, of course, affect the lower income earners more because it's a larger portion of their income. So you're buying a set of tires from the tire store, and if you have a lower income, that everyone pays that same flat rate for that set of tires, so it's going to, of course, impact the lower income earners more than the higher income earners because it's a larger portion of their income. And the same goes for sales taxes, and there are a number of other type of excise taxes that are out there. Sin taxes for cigarettes, gasoline taxes, taxes on alcohol, and etc. Anyway, the question here is that why is the federal income tax a progressive tax? And it's pretty straightforward. You're being taxed at a certain rate. So for the first, again, as I said before, say you're earning $100,000, and again, I don't have the rates here. I'm sure I have them later on, but we'll just use this as an example. You're earning $100,000, And the first $25,000 you're paying 10%. And then for the balance, you might be paying at a higher rate, meaning 15%. So this is the progressive tax kicking in, meaning the more income that you earn, the more taxes that you're going to be levied against you at a marginal rate, meaning at various margins. First 25,000, 10%. Beyond that, you're paying 15%. That's the nature of a progressive or graduated tax, income tax in particular, federal level. As we just indicated, the federal income tax scheme, if you will, is a graduated one or a progressive tax. And the idea is that the more income that you're earning, it's taking some away to try to make that income distribution more equal. And that's the idea behind it. And that was why when it was first levied back in 1914, there were taxes prior to that, but this was the first formal federal income tax setup, which also was concurrent pretty much with the Federal Reserve System, the central banking system in the U.S. But at any rate, it's pretty straightforward. When we talk about the income before taxes and transfers, and the income after the taxes and transfers. So the idea, of course, is that the more income that you're earning, the more taxes that you're actually paying, the more it's being redistributed. So this is that income distribution. This is the redistribution scheme, trying to taking from the rich and pushing it toward the poor. And we'll get into this a bit more because oftentimes the real question you have to ask when we talk about the efficacy, the efficiency in the tax system, you have to wonder because there's always this tendency to say, oh, we got to tax people more, tax the rich, tax them, they're greedy, and so on and so forth. But at the same time, what I would put forth is, and I'll just say this right now, I'll be mentioning it more often. If you're receiving more than your opportunity cost compensation, major league pitcher earning in excess of $20-30 million a year, and it's on the low side now. That's hard to believe. You're certainly earning more than your opportunity cost level of compensation. So the point is that why we've got a choice, I guess. If we want to redistribute income, we could do it through the tax system, which is not very efficient because the reality is if you're rich and if you're getting high income, your chances are you have a staff of tax accountants and tax lawyers and so on and so forth to help you to hide that money, right? Another probably a better way, a more efficient way would be not to get it in the first place. And the way that happens, of course, is that when you have more competitive markets. Remember, we go back to that. Anyway, I'll step off that one and we'll continue to move on. So this is the objective of this of the tax, the federal tax system is to redistribute that income. So when we talk about the income distribution and we're moving, and this is called the Gini index or the Gini coefficient, Gini, an Italian economist. I'm not even sure if he's alive or he's probably been dead for many years. At any rate, I should know this before I start yammering on about it. But the point is that when we look at this, the Gini index, what it does, it goes from 0 to 1, as in 1.00, right? 0.0 to 1.0. And with 0 being the income distribution is absolutely equal. And moving to 1, so everybody has the same exact income. Only one person has all of the income. Okay, so remember, the lower the number, the better off you are. So in our presentation here, we have going back to the 1960s, so well into last century, up to current days, up to 2020, roughly speaking. So what's happened is that income distribution has grown less equal. It's grown more disparate. So it's moved away from income equality. So we were moving from below 0.39 up to 0.49. It doesn't, and the numbers are somewhat irrelevant. It's just the idea that, we're just moving from 0 to 1. And so we moved quite a bit, going from 0.39 up to 0.49. And again, with 0, with the lower number being a more equal income distribution. So what happened was, though, if you look in 2017, we were at 4.89. In 2019, it had dropped down to, again, 0.484. So it actually had improved, meaning it had moved, that income distribution had actually improved, moving in the direction, anyways, directionally more toward income equality. And then it popped back up. And this happened as a result of, at least in part, as a result of COVID. And I'm not sure where I think this is the latest data that we have. But at any rate, this is the Gini coefficient. There's also the Lorenz curve, which is basically the same thing, looking at that income distribution. And this is where it's measured again by the Census Bureau, and it's published on an annual basis. And the objective is to move this down. And again, you'll notice in this graph, I apologize, moving from right to left, kind of backwards, but that's the way the data is actually presented by the Census Bureau for whatever reason. So looking at using this Gini coefficient or Gini index, it's referred to as coefficient here. That's the term I had always heard, but Gini index, Gini coefficient, it's all the same. What you'll notice is that the US, for example, we're between 40 and 50. That was at 0.4, whatever it was, 0.484. And between 40 and 50, that percentile, that percent. And that makes us probably with less equality, moving away from that equal income distribution, as opposed to other countries, including Canada and Mexico. It's surprising about Mexico. It was not the case in the past. But you'll notice countries like Brazil, and I think that might be Colombia, in South America, they are in worse shape, if you will, than we are. And Africa and parts of the Middle East, similar situation. And also in Southeast Asia, there's a fair amount of that, including the Philippines. The idea, again, is that what we want to do is move more toward that equal income distribution. And for us to be where we're at, we're definitely on the wrong side of it, if you will. We should have a more equal income distribution. And the question again comes down to, how do we get to that point? We're a wealthy country. We're a high income country, obviously, a high per capita income country. And how do we achieve that? Do we achieve that through higher taxes? I don't think so. That hasn't really worked all that well in many cases, and I'll just throw that out there. But that might be the solution. I mean, it could be this could be fixed immediately by doing what? By raising taxes. But again, is that the right way through this? It doesn't seem to work very well. I'll leave it at that. So one more time, when we talk about profits, and remember, profits flow back through to the household in the form of income, and so that's why it's pertinent. It pertains to this discussion. Profits are considered a cost in economics. It's part of the opportunity cost. It's under the cost curve, as opposed to accounting. When we talk about profits, it's the residual. It's what's left over after you take revenues and subtract expenses. Again, results in that residual net income or net loss, if you will. Taxes, again, we talk about, there are two different ways of looking at taxes. Remember, our income goes to where? Taxes first, consumption and saving. So these taxes, when we talk about the incidence and the burden of taxes, the incidence is where the tax lands. there are all kinds of taxes out there. We know this. There are income taxes. That, of course, that's easy. It's be on your income, and your income is either your labor, could be dividend payments, and so on and so forth. So this is looking at that individual paying the tax for that. There's the other incidents might be like a corporate tax, for example. Corporate tax, the corporation pays the taxes, the firm. Remember, the firm answers the question where costs are transferred back and forth. So if the firm pays a corporate tax, what are they going to do with that? It doesn't just stay there. It's either passed on to the household as consumer, or it's passed backward to the household as owner of productive resource in what? In terms of lower income. So this is where we say the incidence of tax is one thing, the burden of tax, all taxes are all ultimately paid by the household, no matter where that incidence occurs, whether we're talking about a corporate tax or an income tax or sales tax or any kind of tax. Ultimately, that burden is going to land squarely at the household, at the foot of the household. So onward. Horizontal equity in terms of the tax burden means to treat similar taxpayers similarly, flat taxes, etc. Vertical equity is treating taxpayers of different incomes or wealth differently. Those are two different types of income when we talk about income, that is what you're receiving for the use of your productive resources over a period of time. Wealth is what you're accruing in terms of, remember we said income goes to, excuse me, income goes to taxes, consumption, and saving. So it's that accumulation of the saving. That's where wealth comes into play, the money that you set aside, okay? So the latter, if you will, this vertical equity is highly subjective, and the latter is highly subjective compared to the former type of equity, meaning vertical is very subjective as opposed to the horizontal. Horizontal is straightforward. Everyone pays the same, basically, flat taxes, etc., versus vertical, where you're treating different income earners differently, people with different wealth differently, estate taxes, and so on and so forth. So again, types of taxes would include the graduated progressive income tax, the federal level. Flat taxes would be some state taxes or flat taxes. And they tend to be regressive because everybody pays the same rate of taxes. They pay 6% sales tax, for example. Whether your income is $1 million or it's $10, if you're buying something, you're going to be taxed at the same rate. That's why we say it's regressive rather than progressive. It's regressive because it takes a bigger chunk out of your income at the lower income levels. Again, income taxes are typically at 3 levels. There might be more, but I'll leave it at that. At the local, some locals, some cities, communities have local taxes, state taxes. Some states don't have any taxes, don't have any income taxes, rather. They have other taxes, trust me. And at the federal level, of course, we've got income taxes there. So that's it for that. And a progressive tax, again, is defined as a tax that takes a higher percent of a person's income. The higher is that income, and the lower percent of the income of lower income persons. It does not speak to the absolute amount of taxes paid. It's a ratio, okay? How can we correct the burden imposed on lower income people in terms of regressive taxes? So that what could be done for, we'll say, a flat tax. The idea behind a flat tax is everyone pays the same amount, 10% across the board flat tax. What you could do is say, okay, there's a 10% tax across the board on income, but if you are earning, it's basically working its way back into a progressive tax type of arrangement. But for example, lower income people might get a break on some things, get a tax deduction or a tax credit for some things to kind of fix some of the inequity that would be associated with the lower income earners paying a larger percentage of their a larger amount of their income than the higher income earners, if you will. And now at last, I've got my federal income tax and marginal rates. So, and this is whether you're single, married, jointly, married filing separately, head of household, different categories as such. This would be for federal income taxes that we're talking about. So just say a single person, we'll focus on that. Up to about $10,000 paying 10%, and then up to from about 10,000 up to 40,000, you're paying 12%, 22%, 24%. These rates are somewhat off, I believe. I've got to take another look at them. But anyways, you get the idea. This is a progressive tax. The more income that you're earning, you're paying higher rates as you move up so far as your income category is concerned. So, for example, a person earning $523,000, $523,601 or more, they're paying 37% on that portion above that. And for the 35, they're paying the 35%. They're paying for the 210,000 up to the 523,000, if you will. So they're paying only for that segment, the higher rate or the lower rate. All right. So in Michigan, 2019 income tax rates, marginal tax rate is set at 4.25%. The effective tax rate is about 3.98%. The reason it's a little bit lower is because you're able to, you have an exemption, meaning that part of your income is not taxed, right? So at any rate, this is just an example of federal and state income taxes. Michigan has in theory, at any rate, they've got a flat tax at 4.25%. So these tax rates, these federal, or excuse me, state income tax rates, they go from anywhere from 0 up to I think California is over 10%. I can't see it here, but we'll just say 10%. So that's quite high. Some other states are quite high as well. And really, when we talk about taxes, it's the overall tax burden that we want to focus on. But nonetheless, this is a major part of it, your income. If you're being taxed on your income at 0% in a place like Texas has no state income tax, or Florida, no state income tax, or Nevada, no state income tax, it's very appealing to people thinking about, if you think about it that way, it's very, very appealing. As opposed to a Michigan at 4.25, kind of somewhere in the middle. But again, it's interesting, all the different tax rates based per state, if you will, as you go through states. So when we talk about payroll taxes include like withholding taxes, and it could be some other taxes you could throw in there that we never even see. But that could include such things as unemployment taxes, federal and state, paid by the employer. So when we talk about FICA has to do with social. I don't even know what it stands for. I should. But anyways, FICA includes Social Security and Medicare. So what happens with this is that we take 6.2%. The employer pays 6.2% on Social Security, and Medicare it's 1.45, so it's 7.65 in total that the employer kicks in. The employee also pays that amount. So if you are self-employed, you get to pay the entire amount, which would be what? It's about it's about 15%. I should know this off the top of my head. I just don't have it in front of me again. So at any rate, these it's about 15%. At any rate, if you were the only person, if you were working for yourself, you'd have to pay both sides. So this also goes back when we think about the burden of taxes. This is a tax. Social Security, Medicare, this FICA, these are taxes, right? This is reducing your income. And people would say, wait, your employer kicks in part. No, think about it. Remember what we said before. The employer pays it. That's the incidence of tax. But who actually bears the burden of that? It's either going to be passed forward in the form of what, higher prices to the consumer, or passed backward in terms of less income to the household as provider of the productive resource, labor, right? Chances are most all of this is going to be passed backward to the household as the owners of those productive resources, again, in this case, labor, all right? So when we talk about corporate taxes, remember, who bears the burden of corporate taxes? Ultimately, it lands on again, squarely on the shoulder of households. And if you're not collecting as much taxes, of course, you're not getting as much revenue. So how do we make up for that? How do we justify having a reduced income tax rate? Well, part of this has to do with what? Competition, because we're competing with other countries out there. So, for example, Ireland has had a very, very low federal corporate tax rate. And this is why in Ireland you have many companies that are making that their home base, where they call that their headquarters, where Intel and many other major companies, they choose to call that home. And the reason they do that, of course, is because the lower corporate tax rates. So this is very attractive for companies. So if you want to encourage more businesses, more companies to make their home to be domiciled in that country, the lower the tax rate, the better off you are. And the U.S. Had a higher tax rate before. I believe it was 25% or more, maybe 30% or more. And it's been dropped down to 21%. So that's very conducive, very welcoming for businesses to come in, which it's a positive thing, really, if you think about it, because the more businesses that are attracted, the more employment kind of follows. And on top of that, you could also have a situation where if you make it attractive enough with the tax cut, you may end up collecting, or likely end up doing what? Collecting more taxes as a result thereof. At any rate, the U.S. has, again, a reasonable tax rate, federal corporate tax rate. Just as at the federal level, there are also corporate taxes paid at the state level. And again, it's one of those situations. It's not very welcoming for states to have a high corporate tax rate. It tends to push business away, right? And Michigan, again, is at 6%, which is, again, somewhere in the middle is really what it comes down to. So it's not, the business climate is not terrible, but nonetheless, all these things are, you have to weigh all of these things so far as when you're making decisions if you're going to relocate to one state or another, right? So what I was saying before was that states have different schemes, different ways of collecting taxes. What taxes are higher? Some taxes are higher, some taxes are lower. Sales tax is another classic example. Some states have higher sales taxes. Florida has high sales tax. Has zero income tax. Texas, high sales tax, zero income tax. Nevada, zero income tax, high sales tax. Lots of tourism for Florida and Nevada, of course. Texas, there's just a lot of activity, a lot of people living there. So the sales taxes are again relatively high to make up for the zero income taxes. And Michigan's about in the middle, if you will, at 6%. And so far as the Great Lakes region, this is typically who your neighbors are. So Wisconsin would be the lowest, Illinois is higher, Indiana is higher, and Ohio is higher. So Michigan is probably in a pretty good position so far as sales tax is concerned, not pushing customers away. So one note here, Sales taxes are what are called, there are two types of taxes, basically ad valorem, and then there are ad unit taxes. Ad valorem would be a sales tax, whatever value, whatever, if you spent $1.50 on an item in the store, you're being paid, assuming it's a taxable item, right? It could be food type of a situation where it's not taxed, but assuming it's a taxable item, you're being paid on the value, how much you're actually spending, as opposed to ad unit taxes. Ad unit taxes are, if you're buying gallons of gasoline, you're being charged. One of the taxes are, it's actually taxed both categories in the state of Michigan at the state level. In addition to that, there's federal taxes, but at the state level, you're paying per gallon prices for taxes for gasoline, and you're also paying ad valorem. You're paying a sales tax on top of that. Okay, so ad valorem is a sales tax. Ad unit is per unit, whatever it is you're purchasing. And so here come the sin taxes. And what we mean by sin taxes is it's generally like a group like cigarettes, I suppose marijuana, alcohol, the taxes that are levied against these items where, at least in theory, I should say in theory, and idealistically, you want people to not smoke. But the reality is that most states don't mind it so long as the revenue is intact. So yeah, being cut back on the smoking, but we want to keep our revenue, right? Or we want to increase our revenue if at all possible. So at any rate, the state cigarette taxes, excise taxes are pretty straightforward. And a lot of this is regional dependent. Some are very, very high. Like New York, it's $4.35 per pack. That's what we're talking about. It's extremely high. So what happens when you have extremely high taxes on sin taxes on such things as cigarettes? Smuggling, cigarette smuggling by state. New York, of course, had the highest tax on cigarettes, and they are number one so far as smuggling is concerned. Absolutely enormous. So we're saying as a percentage of total cigarettes consumed, 53% of all cigarettes that are smoked in the state of New York are smuggled. Bizarre, huge numbers, aren't they? California, it's 47, 40, 48%. Again, extremely high. And what's interesting is you'll notice a lot of these are border states. So that would tell me that perhaps cigarettes coming in the Southwest, coming across the border from Mexico, cigarettes are probably less expensive, as has been the case at times with the New York bordering on Canada, on Ontario. Lower cigarette prices, if you will, because of the taxes, perhaps in Canada. That's kind of gone up and down over the years, but at any rate, you get the idea. So distilled spirits are liquor, not beer, not wine, but liquor. Distilled spirits, right? Think vodka and whiskey, etc. And again, all part of the sin taxes, all part of these are excise taxes that are being paid. And this is per gallon. So of course, the liquor is not usually dispensed in gallon containers. It can be, but so in Michigan, for example, that amounts to close to $12 per gallon of distilled spirits, right? So higher taxes don't always correlate with healthy tax revenues. This is back to what I was saying before, and that is that the higher rates, it's at least nominally for public relations purposes, we want high rates of taxes for cigarettes and liquor and marijuana or whatever. We want high rates of taxes because we want to discourage people from smoking or drinking too much. But the reality is that we want them to, we really want to, as a state, for example, we want to maintain healthy tax revenues. So this is the conundrum that they face, if you will. I've got to repeat here so far as this is gas taxes. So gas taxes in your state. The reality is that most gas taxes are total state taxes and fees on gasoline. This is cents per gallon. And so it's an odd mix because remember, we have ad valorem and ad unit. So we have it based on sales tax in Michigan, for example, and we also have it based on the amount of gasoline per gallon that's actually been dispensed. Taxes are quite high, so this is on average, if you will, per gallon of gas that's dispensed. And this was in July 2020. I think it's gone up since then. But the reality is, like you look at California, 62 cents. Yes, their gas prices are high, but some of that, at the very least, has to do with what? High taxes that are being paid. So this was based on, if it's on here, don't have it in front of me, but we'll just say this is probably based on $2.50 gasoline. So keep that in mind. So we're at $5 or $4 or whatnot, significantly higher than what this was based on. So the taxes collected would be significantly higher. So as I was saying, the gas taxes went up in Michigan. So the gas tax went up in January 1st, 2022. How much will this increase cost us if the rate of inflation is 5% or higher? Our state gas tax will increase from 26.3% to 27.7%. And yes, we were higher than 5%. Back then, put this together, it was at 5.8%, but it's gone up significantly since then. Not sure where it's at when you're viewing and watching this, but it is something that's driven by inflation. Trying to stabilize the revenues flowing in. What are you paying for gasoline? Paying right now for a gallon of gas, and what are we paying right now per gallon in Michigan gas taxes? Federal tax is 18.4%. This is ad unit per gallon, 18.4%. Cents per gallon. The state gas tax is 26.3% per gallon, up to 27.7%. On top of that, that was an ad unit tax as well. We're also privileged to pay that 6% state sales tax. That's ad valorem, as in the dollars that you're actually spending, you're paying that sales tax. So if a gallon of gasoline costs $3.20, you would be paying 18.4 cents in federal taxes plus 26.3 cents state taxes, and I should say 27.7, right? And an additional 17 cents in Michigan sales tax. This would bring your total gas bill up to 61.7 cents per gallon. Michigan ranks around 10th so far as gasoline taxes collected. I think it might actually be a bit higher now. So just to kind of restate this, what we've already gone through, taxes, regardless of where the tax lands, whether it's on the household itself or on corporations or wherever, the household ultimately bears the burden. Why? Because the household, remember the firm, if the firm pays a tax, the firm answers the question where costs are transferred to and from, right? So they could be passed forward in the form of higher prices to the household as consumers, sales taxes, excise taxes, corporate profit taxes. They could kind of go back and forth, or they could be passed backward in the form of lower income to household, the provider of those productive resources. Personal income taxes are certainly passed backward. Corporate profit taxes are passed backward to the household in the form of lower dividends. And it could also be in the form of lower compensation for the labor to offset some of those corporate profit taxes. Payroll taxes, Social Security is passed backward to the household as a provider of productive resource. And it's, again, some of these are passed backward and forward, but for the most part, most of these, if you'll find, they're being passed backward. Medicare is the same. as Social Security, SUDA and FUDA, unemployment insurance, passed backward typically. That's and then workers' compensation similarly passed backward to the household as owner of productive resource. But the takeaway is you can argue about where it goes, but I mean which way it goes, forward or backward. If it's passed forward, it's to the household as consumer in the form of higher prices. Passed backward, it's lower compensation, lower income paid back to the household as owner of those productive resources. You can argue about which way it goes, but ultimately, where does it end up? You guessed it, at the household. So this is kind of wrapping it up and again trying to put a bow around this. I've talked about this a bit before, the efficacy, the efficiency of the tax system. And the idea is that rich people are able to do what? They're able to, again, afford lawyers, they can hire as many accountants as needed to protect their income. And there's an expression a professor of mine once said. He said that rich people are like grease pigs. You can try to tax them, try to catch them, but they get away. They figure out some way to get out of it. And this is certainly the case. So this is, if you think about it, this is like, the horses out of the barn type of a scenario in terms of once you give the people that, provide people that income, it's very hard to claw it back, to take it back from them. They find different ways of avoiding taxes. I didn't say evade, avoiding taxes. We're going to keep it legal here, right? So the idea is, again, the path to more equal income distribution, taxes, income received after the fact, or through competitive markets, through this idea of equity and efficiency. Meaning, again, if you have more competitive markets, people won't be receiving income in excess of their opportunity cost. So the example I used was the baseball player. And people would argue, wait a minute, baseball player, they're the absolute best in their field and they should be compensated accordingly. And we were saying, well, then does that $25 million a year, does that constitute being paid accordingly? Yes, in a sense it is, because in a relative sense, relative to other players, they are earning a competitive salary. There's no doubt that on the field, the professional sports, they're the top, they're the tip of the spear, the top of the iceberg, whatever you want to say. They're the cream of the crop. So it's very, very competitive on the field, on the ice, on the court, etc. But the reality is that in terms of a business, because remember we talked before about this, how they've been protected and have been able to be monopolies in effect, monopolizing various geographic regions. They've been allowed to be monopolies, and as a result of which they don't have any competition in a business sense. So when you have that, then of course what's going to happen is there's going to be producer surplus. There's going to be economic rent. There's going to be incomes well above and beyond their opportunity cost level of compensation. So the key to this is, the takeaway is, the more competitive the markets are, the less the need for redistribution so far as taxes are concerned. It doesn't mean there are no taxes. It means that there's less of a concern. It could move more toward a flat tax, would make more sense if you had more equal income distribution. So this is just something that, do we have it? No. Do we have anywhere near it? No. Could we do this? Yes. This is something that we should aim for. We should aim for pushing toward more competitive markets, because who benefits from competitive markets? The household. Household as consumer, certainly, but also the household as provider productive resource, because what happens is that really helps in terms of maintaining employment levels too. That's another discussion for another day. But the idea again is that which one is more efficient, trying to get the money back after they've already been paid, or not have them not receiving the money in the first place, that excess that excess income, that producer surplus, that economic rent. So tax cuts, relation to backward bending supply curve of labor. Question: would you work? It's a real straightforward question. If you were earning more income, would you work more? Most of us, including myself, would say yes, absolutely. So if you're going to increase my pay, then I will certainly supply more labor. And that's really the impetus behind tax cuts. And various tax cut schemes over the years, going back to Presidents Harding and Coolidge in the 1920s, JFK in the early 1960s, Ronald Reagan in the early 1980s, George W. Bush in the early 2000s, I think it was about 2004, thereabouts, and of course, President Trump in 2017. The question is, what is the objective? So you cut taxes. What happens initially is that you have fewer taxes coming in, tax receipts coming in. But the reality is that people are doing what? Supplying more labor. If you're supplying more labor, you're doing what? You're paying more taxes. So, and it's easy to say that. The reality is that that is exactly what has happened, is that we ended up with, by cutting taxes, we ended up increasing the amount of tax revenues flowing in. So do that as you will. This is the takeaway from it, though.